Gold started the year under 2070, and now we're playing around with 2,600, 2,700. So what's got to happen is there's got to be a shift in psychology where people say, oh, this is the real deal. And gold's not stopping at 25 or 26. Gold's going to 3, and then it's going to 4, and then it's going to 5. And I think those things are happening, obviously, over a course of several years. But until they get this fiscal thing solved, and it's not an easy fix, to me, it's very, very clear that we've got inflation in our future. There's no bigger gold bull than me. I mean, I think we're going to 3,000 within the next 6 months. I think we're going to breach that.
The U.S. government's debt has emerged as the top financial stability risk, according to finance professionals, investment managers, and academics surveyed by the Federal Reserve this month. Last Thursday, the U.S. gross national debt officially hit $36 trillion, just over 3 months after reaching $35 trillion, according to the U.S. Treasury. Concerns over fiscal sustainability have overtaken worries about persistent inflation and now rank higher than escalating Middle East tensions, uncertainty around U.S. policy, and the potential for a U.S. recession. Lawrence Lepard, founder of Equity Management Associates, predicts that the rising U.S. debt will trigger a sovereign and currency crisis. He points to signs already emerging, with gold nearing record highs. Lepard also discusses the possibility of a debt reset in the U.S., which could result in gold being revalued between $3,000 and $5,000 per ounce. Gold prices climbed 6% this past week, marking the most substantial weekly gain in 2 years, and closing above $2,700 per ounce. The precious metal is nearing its all-time high, just below $2,800 per ounce last month. The gold market is significantly influenced by rising global demand, with central banks continuing to increase their gold reserves. The Shanghai Gold Exchange data points to strong demand for physical gold, driven by market uncertainty and global events. The current market conditions, geopolitical tensions, and forecasts from major institutions suggest that gold will trend toward the psychological barrier of $3,000 per ounce in 2025. Lepard emphasizes that the key to future stability is a change in public perception, understanding that the rise in gold prices is not a short-term phenomenon. His message to investors is clear: align yourself with this economic shift now, as there won't be a second chance. He warns that a potential monetary reset is a one-time event, and those holding traditional bonds without exposure to sound money like gold could face significant losses. Join us as we dive into the video for a deeper look. Don't forget to subscribe and click the bell icon to stay informed about our latest updates.
Right now, debt to GDP in the United States is about 124%. And we've got a fiscal train wreck going on, and the government, what happened is the government spent a lot of money during the COVID event, and they never cut back. In fact, they stepped on the gas. And so we just finished a year where they spent $6.75 trillion, which is almost as much as they spent in the peak year of COVID. And we've got an economy that's full employment, or close to full employment. And we've got, a stock market that's at record highs. And of course, they did a lot of it. They did this to try to win the election, and they weren't successful. But I think that's part of the reason why they were so profligate. And really until Trump won, and now they've created this Doge committee, there's been zero discussion about the debt problem. But it's a big problem. I mean, it's going to cause serious economic issues in the next year or two. This is going to lead, in my view, as I've said many times, is going to lead to a sovereign debt crisis and a currency crisis. And you can already see that. I mean, the evidence that that's taking place is that Bitcoin's at record highs and gold's near record highs. And I mean, gold was at a record high just recently, just backed off a little bit. But, gold started the year under 2070, and now we're playing around with 2,600, 2,700. Bitcoin started the year, at 58, actually it was even lower than that, I believe, but it was at 58 for a big part of the year. And of course, now we're pushing up against 100. So these two sound money assets, sound money alternatives, things that could be a neutral reserve currency, they know it. They can see the problem. And they're responding.
So what do you think? Do you think the average population, I mean, we've been watching these inflows, do they understand?
No, see, that's the thing. I don't think most people get it. I think a lot of people look at this and they, particularly, I mean, I noticed in the gold space, the gold stocks, as you know, and as I've talked about other podcasts, really haven't responded the way they should have. Gold's up 30%, the stocks are up 30%. Typically, the stocks are 2 to 3x the gain of the underlying metal. And in this case, that has not happened. And the reason for that is if you go on Bloomberg and you check the future forecast, nobody thinks the gold move is real. Everybody thinks, oh yeah, it's at 26, but it's coming back to 2,000. And the ASICs, which is the all-in sustaining cost of mining an ounce, are going to continue to march up with inflation. $2,000, pretty soon your margins are gone, right? And so what's got to happen is there's got to be a shift in psychology where people say, oh, this is the real deal. And gold's not stopping at 25 or 26. Gold's going to 3, and then it's going to 4, and then it's going to 5. And I think those things are happening, obviously, over a course of several years. But until they get this fiscal thing solved, and it's not an easy fix, to me, it's very, very clear that we've got inflation in our future. But the book is I'm very cautioned, I caution people about, you want to be on the right side of this because you're not going to get a do-over, right? I mean, if we really go through a monetary reset, it's a one-time deal, and if you've got bonds and you don't have, sound money, I think your condition's not going to be very good.
Gold's price history highlights its importance as a hedge against economic uncertainty. Between 2020 and 2024, gold saw significant gains driven by geopolitical tensions, supply chain disruptions, and rising inflation. In 2024 alone, the price per troy ounce surged by over 30%, reflecting sharp market volatility. Lawrence Lepard points out that if historical metrics from 1971, when the U.S. was on the gold standard, were applied today, gold would need to be valued at $79,000 per ounce to fully back the U.S. monetary base. This valuation underscores his belief that gold remains significantly undervalued. Lepard's top investment choices are gold, silver, and Bitcoin. He emphasizes that silver in particular is deeply undervalued, especially considering its critical role in modern industries. Emerging technologies like solar energy and solid-state batteries are expected to drive demand for silver, which he believes has yet to be fully reflected in its current market price. Now let's redirect our attention to a video.
There's no bigger gold bull than me. I mean, I think we're going to 3,000 within the next 6 months. I think we're going to breach that. We need to. Gold is so deeply undervalued, it's insane. It needs to be in a different zip code. So I see 4,000, 5,000. At the end of the cycle, it could be 20, 40, 50. I mean, which sounds absurd, but it's not. It's really not. I mean, if you take it and if you did the math the way we did it in 71 when we were on a gold standard, Brent's done this actually, you'd need to be at $79,000 per ounce gold to balance the out, and that's assuming we have the 261 million ounces.
Into that a bit. Break that into it a bit.
So just take the broad monetary aggregates from the 60s. Right. Divide U.S. theoretically has 261.5 million ounces of gold. Okay. And I say theoretically because, Ron Paul personally said to me, I'm sure we don't have it. Yeah. Okay. So, but all right, fine. Let's assume we do, okay, for the sake of argument. And it's in the Treasury. The Treasury owns it, and they could mark it up. They could turn around, and this is what Luke is proposing, and it's a smart idea. They could mark it up to some saying, we're going to go back to a gold standard and buy and sell at that price. But anyway, back to the math. Back in the 60s, early 60s, before we started the Vietnam deficits, you could take the monetary aggregate, divide by those number of ounces, and you came up with a $35 reference price, which is what they had, they set it at Bretton Woods. Okay, same math, broad monetary aggregate, 261 million ounces, $80,000 an ounce for full coverage. It's nuts, right? It's just, now you don't need to have full coverage to be on a gold standard. Yeah. There are many successful gold standards that have worked at 20% coverage or 30 or 40% coverage. But the point is, even 25% coverage would imply a $20,000 an ounce gold price, which is a long way from 2,700. So gold, if gold is going to be used as money again, it is deeply undervalued. My top assets are just all around, are just gold, silver, and Bitcoin. Right now, probably of those three, silver's the cheapest. It's kind of stunning to me that silver hasn't done more than it's done, particularly given all the new applications that are coming out. We need solar, and this solid-state battery stuff will start to kick in eventually. And so, and it's underperformed massively. Now, that's partly because the stock-to-flow is higher than gold, but I like them all. I like all three of them. I don't like stocks that much. Commodity stocks and foreign stocks. Proctor just had a nice chart showing how cheap international stocks were compared to the U.S. stocks. And I just hate bonds. I just don't see. I know there's some people who think, well, you'll have a deflationary collapse. You'll be really glad you own a 30-year because you'll be locked into a return when there are no returns anywhere. I just don't see them letting a deflationary collapse happen. Now, it's possible though, that it could overwhelm even the printer, and you could get outright deflation. I don't know. It's a messy situation is the only way to describe it.
Gold's history as a valuable commodity dates back to ancient civilizations, where it was used as currency and crafted into artifacts and jewelry. In the modern era, gold is traded both in physical forms, such as gold bullion and coins, and through digital platforms including derivatives and exchange-traded funds, ETFs. Today, the gold spot price remains the primary benchmark for determining gold's value in global markets. Gold has been a cornerstone of human civilization for millennia, valued for its intrinsic beauty and utility in trade, investment, and technology. From the earliest civilizations to modern global markets, gold continues to play a pivotal role as a commodity and a store of value. This concludes our discussion for today. Share your feedback in the comments below. If you found this video useful, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.